Good morning, everyone. Thank you for attending and welcome. Before we get going, I'm going to ask Mike if we have any housekeeping or announcements or anything that has popped up relevant to us before since we've posted this agenda.
Thank you, Mr. Chairman. Just give me 1 second.
Okay.
I'm sorry.
I'll tell you what, while Mr. Hitchcock is looking for that information, I think he's got something for us. We have an agenda that's posted. I'd like to call for a motion to adopt it. May I have a motion, please?
I move.
I'll make that motion. This is Ed.
I have a motion and a second. Is there any discussion? We have an agenda that we will be going by. Mike, are you ready, or you want us to give you a little more time?
Just one more minute, Mr. Chairman. So, all right, if you can go through them. I'll tell you what. I'll just do this in my report, if that's okay.
That's fine. That's fine. All right. Next on the agenda is to approve the minutes of the December 2nd, 2021 meeting. I hope you all have had a chance to read those. Do we have any comments or questions about those minutes from the commission? Hearing none, I'll call for a motion to approve those minutes.
So moved.
I have a motion. May I have a second, please?
Second.
I have a motion and a second. Any discussion on the approval of the minutes from the December 2nd, 2021 meeting? All in favor of adopting those, please say yes.
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 Any opposed, please say no. We have official minutes for the December 2021 meeting. Next up, for the chair's report, I have nothing to report to you folks. For the committee reports, let's hear from each of the committee chairs if we have anything, and if we do, what that information is. Who wants to go first?
The ERM committee is posted online, the notes from the last meeting.
Okay.
So if there are any questions, you can feel free to throw them out there, and I will very quickly defer them to Mitchell, who.
All right. So we had a committee meeting, and that information is posted online. Do we have anything from Human Resources Compensation?
The HRCC has not met since our last meeting. We will meet later this spring.
Okay. Wonderful. All right. Moving along, the CEO's report. I'm going to recognize Mr. Hitchcock.
Thank you, Mr. Chairman.
The floor is yours, sir.
Thank you, Mr. Chairman. I think, if everyone probably will notice, Mr. Feinstein, Robert Feinstein, who I think in the 7 years that I've been here has never not been at a commission meeting, so his absence is certainly felt. But I wanted to let the commission know that one of the primary reasons why he's not here is his mother passed away this past week. Miss Beatrice Dunn Feinstein, lived a long and full life, and just an amazing. I'll send out the obituary to the commissioners, but an amazing woman. A very capable lawyer. When that was at a time when that was not necessarily the occupation for women, a trailblazer in that regard, very much a concerned and active citizen in her community, and also most notably a fantastic mother, grandmother, and great-grandmother. It's obviously a sad time for Robert and his family as they grieve and go through this, but also a time for them to celebrate a long and full life, very much well lived. So just ask you to join with me and us here and the staff in recognizing and sending Robert and his family our thoughts and prayers, and join with us and with them at this time. Also, it is also another reason to recognize Robert as well. And as with most things in the circle of life, there's times of pain and there's times of joy, and this is this also happens to be Robert's birthday today as well. So, and it is a milestone birthday. And I'm sure Robert, being as dutiful as he is listening. So not only, do we offer his family our condolences, but, we also wish him a very happy birthday and extend our best wishes to him for his birthday as well. So, so happy birthday, Robert, and we wish you and your family the best. So, just wanted to make that recognition because Robert is certainly an instrumental force in us having these meetings and making sure that we're prepared and ready. So his absence is definitely felt today. Mr. Chairman, as far as substantive matters from my report, I wanted to, as the commission is aware, state law requires the commission to annually review the statement of investment objectives and policies, and the requirement is that the commission either affirm it or amend it prior to May 1st of each year. State law also requires the commission to adopt an annual investment plan. And I think, as most of us are aware or recall, in 2020, the commission made the decision to combine these two requirements into one document to make sure that we were ensuring consistency and agreement between the two requirements, because there is a degree of overlap between the two. And, some things that are required to be in the AIP are a little bit more permanent in nature that probably find themselves better in the SIOP. So the decision was made to combine the documents. I would like to go through the proposed changes for this year in just a moment, but just to, from a high level, the majority of the changes are really conforming in nature. There's a few substantive changes that I'll make sure to highlight. And as pursuant to our practice, my intent is simply to go through the proposed changes with you at this meeting, obviously answer any questions, and certainly the commission is free to engage in any discussion that it would wish to, and then come back and ask the commission to adopt a final document at the April meeting so we meet that May 1st deadline that's required by statute. So I will just proceed through the documents and try to make sure that I'm highlighting the changes first. And this is in the red numbered document on page 10. And on this change, basically on this page, is simply conforming the funded percentages for the various systems to the actuarial evaluations, the most recent actuarial evaluations. I think the most notable thing about this change is for all 5 systems, the funded percentage has improved, which I think is certainly a milestone that is worth noting. Which at the bottom of the page, and moving over to page 11, we make sure that we note that we are seeing improvement in both SCRS and PORS, because SCRS has reached the 20-year amortization period, and PORS has reached the 18-year point of the amortization schedule. And just for reference, just a reminder to the commission, one of the big major changes and for the better for the plan and the 2017 legislation was to require that the amortization schedule for both SCRS and PORS reduced by 1 year each year until we got to 10. Statutorily, both plans right now through the 2021 evaluation are required to be at 26. So we are at 20 and 18 respectively, we are ahead of schedule for both, which I think is something that's worth noting. Moving here on page 12, this is just simply I'm just making a conforming change to the new 7% rate of return. I think, as everyone is aware, under the pension reform bill, PIBA, in consultation with us and the actuaries, is required to submit a proposed assumed rate of return every 4 years to the General Assembly. That was done for the first time last year, and the General Assembly, much like a regulation in the way that they handle regulations from state agencies. The General Assembly has the ability to accept, reject, change, and deal with that recommendation as they see fit. However, if they don't take any action, then the assumed rate of return that's proposed just simply goes into effect. So this notes that the assumed rate of return dropped from 7.25 to 7%. If we look on page 13, what you see is, and this is, this table has appeared in the document for the past several years, Table 1. And what this table does is track the base case scenario as well as potential probability of the fund reaching, and we use FCRS as an example in this, reaching fully funded status. We have seen improvement in this table year over year, and that's due, one, to the performance of the fund last year with a 28.6% rate of return, as well as some slight improvement in capital market expectations that we get annually from Makita, and we'll hear a full presentation on those capital market expectations later on in the meeting from Makita. The change on this page, on page 14, is really just conforming and this is just a recitation of when the base case scenario of when the fund is expected to get to fully funded status based on this is stochastic analysis that we conduct internally, and this shows the kind of the year-over-year progress of that versus last year. Table 2, which is on page 15 in the red numbered document. This table tracks the expected contribution rates, base case scenario, as well as kind of the range of probabilities of the 5th to 95th percentile for what contribution rates will be over what expected contribution rates are. And again, this is just being updated for the last year's performance as well as the slight improvement in capital market expectations. And what we see on the next page is there has been improvement in both the base case scenario as to when those contribution rates begin to go down, as well as when we get to normal cost on a year-over-year basis. We also, you see that there's a deletion at the bottom, and that is just simply a footnote that is no longer timely, given it's inapplicable now this year versus last year. On page 17, what we're deleting here is just a specific reference to some factors that were applicable to last year but are no longer applicable. Then let's move on to page 27. And this, on this page, this is the page where we incorporate Makita's capital market expectations as to projected long-term return of the plan, expected volatility, as well as the probability of meeting or exceeding the assumed rate of return. What's proposed here is over the course of several years, we've kind of recited the year-over-year changes. This is getting a little bit, it was my belief that it was getting a little bit long in the tooth in that regard. So I've deleted some previous years' references here and just captured in the paragraph in the underlying paragraph that you see that capital market expectations have fluctuated since we adopted the new asset allocation and when we did the portfolio simplification, and that those capital market expectations and the impact on the plan has fluctuated primarily based on prior year market performance. And I've also incorporated into this document the new expectations for both the policy portfolio as well as the policy portfolio with Fort Walton.
Mike, I just want to confirm one thing, that I'm hearing it right, if you don't mind.
Sure.
So Makita Makita's 20-year annualized rate of return is slightly below the 7%.
Right.
But tables 1 and table 2 have been updated with these revised numbers, and they're still showing very positive long-term
Yes.
impact. And I just wanted to make sure I was hearing that right.
Yes, sir. And a lot of that is,
And I think it's good to say it
exactly.
publicly.
But that's a good point. And what we're doing there is we're incorporating, when we think about the impact of capital market expectations, that is very much of a look-forward view, or a forward-looking view. And what we're seeing in tables 1 and 2, we're seeing also the impact of the actual performance of the plan on a market value basis, and how that, even combined with those forward-looking capital market expectations affect those, the base case scenario, as well as the probability of, for both the funded status and the contribution rates.
Thank you.
That's a good point.
Yeah, I just think for the public who might not know some of the details, they might appreciate hearing that.
And what we have seen is for both and obviously Makita will go into this in their presentation as well, but we've seen an improvement for year over year on how those capital market expectations impact the forward-looking expectations, as well as the volatility and the probability of exceeding the assumed rate of return.
Thanks.
Okay, moving on to page 31. Here, these are the strategic initiatives that we propose and that the commission weighs in on. These are more, I guess, shorter-term goals or strategic initiatives for the investment program. And even though some of these kind of have a life that extends past 1 year, they're more shorter-term priorities that the commission agrees that we should be working on, that the investment staff should be focusing on. We've deleted a few of those because we feel like we've kind of gotten to maximum, we've either achieved those or have gotten to kind of maximum improvement on those. And so we've deleted the comprehensive review of implementation cost. That doesn't mean that we're not tracking. Obviously, we are very diligent about how we track implementation costs. It's just our review of how we're doing that and how we're going about attacking implementation costs. We feel like that we've completed that. But as far as the fee collection and understanding and reporting of those, that has not in any way changed that practice. Secondaries market. That is another one that we're proposing that we delete. The portfolio framework initiative, and if you think that's us reporting performance based on the reporting framework, which includes the reference portfolio, the policy portfolio, implementation portfolio, as well as the actual portfolio, we believe that we've gotten to a good place in that. Yes.
Mike, I would also argue that the secondaries market is embedded now in the surviving second.
Yeah, exactly. Yeah, right. Yeah, and that's a good point, Jim. Thank you. So those we're proposing that we delete, and the ones that we've risk management, we feel like that is one that survives. We're proposing that survives because we feel like that there's still work to be done in our risk reporting and making sure that we're providing a valuable risk reporting data to the commission. As Jeff said, in the fund life, what we're looking for, what we're proposing to focus on there is really establishing a discipline about how we're evaluating our private markets investments approaching the end of their fund life, and coming up with basically a menu of options that we will employ when those investments get to the end of their fund life. And to a certain extent, the utility function begins to dampen a little bit for those towards the end of their fund life. And also human capital, and this is human capital from the perspective that dovetailing with more focus on the investment team. We'll talk about some changes that we're making to the baselines asset class baselines and some of the private markets later on. But we want to ensure that we are staffing in a way, or that we're staffed in a way that will allow us to align our human capital resources with those changes that we're making, and ensure that we're able to source and perform due diligence on new investments in the most optimal way. So obviously, this is our suggestion. This is not intended to be an exhaustive list. Certainly take input from the commission on other initiatives that you may think that we should be focusing on. So any thought on that, we certainly appreciate, and but also incorporate if there's a consensus by the commission on other items to focus. All right. Page 35. And on this page, you'll see basically two sets of changes. And first I'll take Portable Alpha first. What you see in subsection 7 in regards to Portable Alpha, right now the commission gives Jeff discretion basically to have up to 12% of the plan assets in Portable Alpha. And I think the commission is aware that the way that we utilize the Portable Alpha program is basically through exposure to hedge funds. And that is really the only part of the portfolio that we're employing hedge funds. But what we have is there's a 12% limit on Portable Alpha, but later on, if you look down at little Roman numeral 4 at the bottom of the page, you see that hedge funds are not supposed, under alternative investments in Section 8, hedge funds are not supposed to exceed 15% of the total plan assets. To me, that seemed a little incongruent, because I think if you have a 12% limit on Portable Alpha and a 15% limit overall on hedge funds, it creates the impression that we may be utilizing hedge funds in other parts of the portfolio that might be taking up shelf space in other asset classes, which is not the intent at all. I'm proposing, or we're proposing, that those two limits match. We're proposing 15% overall for Portable Alpha. We think, just because we believe that, we're likely to experience some significant volatility in the portfolio over the short term. And, that portfolio is designed to have, it's a low beta portfolio, and it's designed to do well, or, to attempt to do well, regardless of what's happening in the overall markets. And the thing that we don't necessarily want to do is, if we get to a point where there's a, significant market sell-off, if that portfolio is doing what it's supposed to do and delivering us uncorrelated return, we don't necessarily want to have to redeem from that. We don't want to have to punish that portfolio as a result of it actually doing what we want it to do. Again, I think for me, the more important piece is for those two to match. But that's the reason that we're proposing to going from 12 to 15 and Portable Alpha. And we don't anticipate that is going to change the target for us for Portable Alpha. It's just providing a little bit more flexibility in what we perceive to be some market volatility on the horizon. So, in the alternative investment section, you see that this came up in an investment that closed a couple of months ago. We presently have a limitation that our capital cannot exceed 25% of the committed capital of any fund. We've interpreted, unless it's waived by the commission, under the delegation policy, because the ability to waive that wasn't accepted in the delegation policy, we've interpreted that as CEO, that I would have the ability to waive that in the delegated authority that I have from the commission. But I waived that 25% limitation for the first time in the 4 years of the delegation policy a couple of months ago. A question arose as to whether or not there was specific language that allowed me to do that. So I wanted to make sure that I was bringing that to that interpretation, and that the commission was in agreement that that is the case. And you know, what we have here is just an amendment that would allow, that this clarifies that I have the authority to do that pursuant to the reasons that are stated in the exception, and that I would, if I do that, then I would have to make sure that the closing certification conspicuously noted that 25% limitation was being waived, and give the reason why it was being waived. In the fund that we did previously, the reason that it was waived is it actually, instituting a fund structure actually provided us more protection rather than, we could have also structured that investment as a joint venture. We partnered with another institutional investor and did it, and closed that through a fund structure, and which actually imposed upon the GP a duty of care to us that wouldn't exist if there had been if we had done it through a JV. That's the only reason I felt comfortable waiving it. But I just wanted to make sure that it was specific, you know, because there's a lot of reference throughout the SIOP and the things that the commission can do, which, but for the delegation policy, you know, wouldn't be able to be done. So, but this one, since it came up, I want to make sure that the commission's aware of this and is in agreement that this is the correct interpretation. So that's why there's the clarifying language there. Just wanted to note, on page 46, we amended, back in the December meeting, we amended the investment authority delegation policy. The commission agreed to amendments to that. I know it looks a little different, but this is the way that we basically publish it on the website. And so we just lifted this in because if not, the strike version of the track changes version would look like we'd made a lot of changes to it. So that's why we put it in this way. This is just simply us inserting it into what was approved in December. So there's no change other than what was approved back at the December meeting. And then on page 59, and I don't necessarily have we have an amended, this is the part of the Sudan policy. As you know, there's a policy in the SIOP that we've made have adopted pursuant to state law, a state law requirement that prohibits us from investing in certain companies that have some connection or some involvement in the conflict in Sudan. However, the act, if you look at if you look at subsection or section H, A(4), investments that constitute indirect beneficial ownership through index funds, commingled funds, limited partnerships, derivative instruments, or the like are accepted from this policy. And that's basically the way that we gain exposure to any investment is through a structure like this. So in essence, for us, this exception swallows the rule. But there are certain requirements in here. There's reporting requirements, and there's requirements that we basically engage with an outside consultant that provides us with a list of scrutinized companies. There's a contractual fee that we pay them, obviously, to provide that service to us. But ultimately, the way that we invest now would be accepted from, we index and basically all of the other, all of our private equity exposure that we have is through limited partnerships. So in essence, this doesn't apply. So what I'm proposing, and I'm not proposing us doing anything about it today, is that back in April of each year, that we just affirm that, that this exception applies, and that as a result, or that we asked the commission, or we affirm to the commission that this exception continues to apply, and thus we're in compliance with the policy. And it will save us a little bit of cost in how we deal with that, because otherwise it just simply, in both the statute and in the policy, it just doesn't apply to us. The proposal is that when we adopt the SIOP, AIP in April, that we include in that an affirmation that this exception continues to apply, and that we are in compliance with the policy. Because there's like I said, there's costs associated with developing the list of scrutinized companies, and it just, and other reporting requirements. And we want to, since the exception swallows a rule, we want to I think it's easier just for us to say that we're compliant, we're in compliance because it doesn't apply, rather than doing everything that it would to comply with the policy and then saying that it doesn't apply to us. So, but that's not, again, that's not a decision for the day. That's just something that we can come back and,
Mike, is there a gray area where I don't oppose what you're saying, but I mean, if the exception swallows the rule, it seems clear.
Yeah,
So I'm just wondering if I'm missing a gray area or something that we're trying to protect, staff or somebody from.
Yeah, and we'll, we've looked at this, internally, Michelle Kennedy's looked at this from an ERM perspective. Betsy's looked at this too. I've looked at it. We've compared the policy to the statute. We can't see how we're ultimately, how something would not fall into the exception that we have. So I think I would just submit it's just easier for us to say we're in compliance because the exception applies, right? Rather than, developing the list of scrutinized companies. Jeff's supposed to report that to you, and any action that he's taken to either keep or divest of those. But we're not making we're not making any of those decisions, and we don't have exposure. We don't have direct exposure to any underlying company anyway, right? So, so I just feel like it's better to handle this one by saying the exception continues to apply, therefore we're in compliance.
Okay.
And we can make that
Mike, this is Ed. I have a question.
Yes, sir.
Given this Ukrainian situation and the divestiture of investments in Russia, do we have any problem with any of that stuff?
I think we might talk a little bit more about that later, Ed. But I would say that, in response to your question, we have no concern that we have any Russian exposure that we feel would cause us any difficulty.
Okay.
All right.
Yep.
And then moving on to road number document, page 61. That's just the new capital market expectations table that we include in the SIOP on a yearly basis. So that's just the updated table. And then lastly, on page 63, what you see there is we try to keep a record of those tables 1 and 2. We have a historical record of how they change over time, and so we've just updated those with the 2021 version of tables 1 and 2. And those are the changes. Certainly willing to answer any questions, any discussion that the commission would like to engage in. Also, if there's anything in the interim between that any commissioner sees or has concerns about in between this meeting and the April meeting, I'm more than happy to talk about those and to ensure that we're incorporating any proposed changes that the commission would like to see as well.
Any more questions to Mike about the AIP or the SIOP at this point? All right.
Mr. Chairman, moving on to we just wanted to make sure that and this is for situational awareness and information purposes only. We're not necessarily something that we're asking for approval from the commission for. It's just we wanted to make sure that the commission was aware that we've updated our business plan, and the business plan really focuses on our organizational priorities to improve our operational processes and capabilities to make sure that the investment function is being supported in a way that allows us to access the best investments possible. And it's primarily focused on the middle and the back office. So this year, things that we're focusing on are talent management. And one of the things that I wanted to make sure that's clear and that I'll add to this is, in talent management, the goal is to recruit, train, and retain a high-performing and diverse workforce. Obviously, anything that we do we do it pursuant to our fiduciary duty. So I'm going to add that phrase to that goal. We're also focused on increased independent reassurance, upgrading our performance and liquidity reporting to allow for enhanced insights into portfolio management, and also to promote our IT infrastructure and information security. I won't go through each one of those, but the goals are stated, the objectives of how we're going to meet those goals are there. So this is just us updating that and indicating our priorities for both middle and back office. It was also suggested, and I think it's a good idea, that we add this as a section in the SIOP, just so that all of our policies and plans are incorporated into one document. So I think that suggestion was made as we were in the lead up to the meeting, and I think that's a good idea, just to have that in the as an independent section in the SIOP AIP. So certainly happy to answer any questions about the business plan.
Any questions to our CEO about the business plan update? All right, hearing none. Mike, you got anything else for us?
Yes, sir. Just so everyone, and I think everyone is aware of this, as we all know, pursuant to statute, a fiduciary audit will be performed. This year, we're already at the 4-year mark where it's time to do that again. A RFP was done to select the fiduciary auditor, or the firm that will conduct the fiduciary audit. Funston Advisory Services was awarded the contract, so they will be beginning their work soon. I have an initial kickoff meeting with them in a couple of weeks. And as we know, I'll just as a reminder, the state auditor's office is the entity that actually selects the fiduciary auditor. But we were thankfully given the opportunity and to provide input, but ultimately that's a selection that's made by the state auditor's office. But we will be working with Funston, for them to complete their work. But that'll really kick off in earnest in May. I would assume that they will have a report to present to the commission at the December meeting, and then they have to present their final report to the General Assembly in January of next year.
Mike, I know I had a suggestion for the scope, and some other commission members might have too. Did those suggestions get incorporated into the RFP and then the contract?
Yes, sir. Yeah. Yes. Yeah. I know that they were incorporated. I didn't look at the contract, but I feel confident. I know that they were in the scope, so I feel confident they were integrated into the contract as well. Also, just one other item for everybody's situational awareness. One of the things that I want to ensure, especially given that we are, probably coming up on some turnover amongst the commission over especially over the next year, that we have a designated resource for commissioner orientation as well as continuing education. So I've asked Robert Feinstein to take on that role. So he will be, for existing commissioners, he'll be reaching out to you on a pretty regular basis to update you and provide you opportunities for continuing education. He will also be ensuring that our new commissioner orientation provides commissioners with really with the best initial education when it comes to what we do and how we do it. So, I just wanted to make sure that you were aware of that. So if you hear from him with some suggested opportunities, then that's the reason why. And Robert has a substantial amount of institutional knowledge, and I think that he is the best person to lead that effort for us. And I think having a central figure of responsibility for that, it puts us in the best place to ensure that we have, first-rate orientation as well as continuing education.
Great.
And I believe that is it, Mr. Chairman.
All right. If there's nothing else for our Chief Executive Officer, next up on the agenda is a report from our Chief Investment Officer, Mr. Burr.
Thank you, Mr. Chairman, and good morning, everyone. Before I go to our traditional performance update, I do want to take a minute to talk about what's been a bumpy start, to say the least, to 2022. And I want to offer my thanks to our investment analyst team for pulling some material together for me to share with you today. I think it's pretty clear so far this year, the volatility that we've been seeing has been a result of both inflation fears as well as the unfortunate situation in Eastern Europe. And I do think it's appropriate to warn that until markets begin to see a path to clarity on both of these issues, I think we're going to continue to be in for a bit of a bumpy ride. Fortunately for us, we do have very little direct exposure to Russia. It is, I think, well under 10 basis points of our plan. So I'm going to tailor my comments here to the inflation picture and how I think that it is impacting markets. As we sit here today, markets are expecting 5 to 6 rate hikes over the course of the next 12 months. This is a situation unlike anything we've seen recently. What this graph on the screen shows you is how the market has been, its forecast for the Fed funds rate for next January has been evolving over the course of the last 2 years. You can see that during the latter part of last year, something changed, and it changed very materially. Last June, which is kind of 2/3 the way across the bottom of the screen, we were still forecasting a Fed funds rate for next January of 1/4 point. So you can see today, that's closer to 1.7%. So what changed? What has caused the markets to expect that the Fed is going to really have to get aggressive and take rates substantially higher? First, let me share with you something that I think helps understand this issue. The Fed has, for a long time, and we're showing you here back to 1970, been pretty aggressive when it comes to staying ahead of and ultimately stamping out inflation. The red line on the screen is CPI, and the blue line is the Fed funds rate. What we see here with the red line lately is that it has started to lift off, particularly in the back half of last year, but the Fed wasn't reacting. And it's not to say that the Fed has been wrong to not react. If you think back 12 months, the economy began what seemed to be a fairly fragile recovery coming out of the pandemic. But the Fed moving slowly to combat inflation while we were still seeing fiscal stimulus flowing through the economy is really where we've got this divergence. And now the market is worried about what is it going to take to regain control of this situation. So I think that's an important backdrop for this. So what's different this time is that inflation concerns of the past, this time from the inflation concerns that have popped up periodically over the last 10 years, is that inflation is now showing up in a lot of different areas of the economy. We're seeing tightness in housing. In the bottom left-hand chart, you see rent growth now in double digits. The labor market has snapped back very quickly and starting to show serious signs of tightening. Energy prices are high because of a prolonged period of underproduction. This is really broad-based, and it's not easy to see how this is going to play out right now. We're not used to seeing CPI at 7.5%, and that is really causing some stress for markets. So let me just tie it back to what we're seeing in markets. First, the yield curve is flattened. The chart on the top right, even though you would need a jeweler's loupe to see what it's telling you, I can tell you what it's showing you is the spread between the 2-year Treasury and the 10-year Treasury. And that has tightened considerably by more than 100 basis points in the last year. So what that really means is we're starting to see a flattening of the yield curve by the short end rising. Looking at equity markets in the bottom charts, on the left, we're basically showing you that things that we think of as kind of junky have been absolutely taken behind the woodshed and beaten up. If I were to show you the performance of banks and insurance companies, which are traditionally sectors that perform better in a higher rate environment, they're outperforming the rest of the market by more than 10%. So the meme stocks that are kind of the bellwether for junkiness, those have been crushed. On the bottom right, you're seeing this divergence that we haven't seen for a very long time between growth stocks and value stocks. And just think of value stocks as stocks that have earnings today and are paying dividends today, whereas growth stocks are kind of bets on how things play out. Growth is much more sensitive to the discount rate that you use. So there's a lot happening here that is kind of confirming that markets are struggling with this environment. So given that this is likely to persist until we have clarity on inflation, and also I will tie back to the situation in Eastern Europe, I just think it's important to come back to, as it always is, we need to be disciplined. We plan for these types of challenges, or these challenging times, so that when they arise, we'll be able to capitalize on attractive opportunities. And I'll submit to you the bottom part of the page is the playlist. We're going to keep rebalancing. We're going to remain liquid, remain disciplined, patient. We're going to plan for challenging times. And when challenging times offer us opportunities, we're going to be ready to take action. So let me pause there and see if there are any questions.
Yeah, Jeff, this is Ed. The shrinking of the yield curve. Historically, what is that said about the course of the economy going forward? Isn't there some relationship between the yield curve and recession?
Yes, it is a flatter yield curve. Think of it as, especially when it is driven by the front end rising, is a way that we typically see the central bank attempting to pump the brakes on an overheated economy. That transmits, of course, through interest rates. So when the Fed raises the front end, that is very much what it is attempting to do. So I wouldn't say to slam on the brakes and send us into a tailspin, but they're trying to engineer a kind of gentle cooling of economic conditions through rates. So that is something that, as opposed to the low rate environment just generically being a tailwind, that's the Fed attempting to kind of manage a slowdown in the economy and to prevent us from overheating and ultimately having an unmanageable situation, like a unmanageable recession that turns into something worse than what we typically expect in a recession. Is that helpful, Ed?
Yes.
I am flanked by economists, so I would very much, if there's anything to add to that question, I would certainly defer to others as well. So
I just, not about that point, but about the comparison of growth and value stocks.
yes, sir.
Does that have implications for our private equity component to the extent that that seems to be sort of growth oriented?
So that's a great question. I would not characterize our private equity portfolio as overweight to what we think of as growth sectors relative to the kind of the public markets. I think it's a challenge for every risky asset, the higher rate environment. I wouldn't narrow that focus just to private equity, but we do have some flavors of private equity, specifically growth equity and venture capital, that may be more exposed to this type of phenomena. But we also have things in our portfolio like Brookfield and Apollo that very much can make fantastic returns from this type of environment. And we do have a considerable amount of exposure in that portfolio still to financial services, which is a part of the portfolio would benefit as well. So I think we are nicely balanced in that portfolio. Other questions before I move on to performance?
I've got one, Jeff.
Yes, sir.
And this might go back to the other factor, the situation in Ukraine might be the driver here, but, you know, I've heard some say, you know, that Europe might be headed for a recession pretty quickly, you know, and also, so what's the outlook, your view on Europe, but also emerging markets in general because of this situation?
So I will say that relative to 10, 15 years ago, emerging markets in Europe, and frankly, everything that is not U.S., has a suppressed kind of value in our public equity index. So it's just the U.S. has had a very long run and performed very well for longer than the rest of the world. So I want to temper my comments in that way. Emerging markets have had a reasonably tough go for the relative to developed markets of late. I think that the headlines in Eastern Europe certainly present some challenges for emerging markets, whether investors like us say enough of emerging markets and we decide to go express a developed market bias beyond what market cap already does. So I don't have a great degree of confidence in calling a recession anywhere. So I don't want to necessarily go down that path. Europe certainly has challenges made more acute in the last month. I don't know that I have clear sightline on whether that is enough to tip the European economies into recession. I just don't have that level of clarity at this time. So apologize for punting
No,
the question,
no, it
but,
is.
you know, they've had slower growth than, rest of the world for quite a while.
Yeah, it seemed like 2 months ago, I heard people talking very favorably
Yeah.
about returns or the forecast for Europe. And now all of a sudden it seems to have turned completely.
I'll defer to Brian on this, but I believe in the first half of our fiscal year, which we're about to look at the performance for, U.S. underperformed rest of world. You know, but our status as a reserve currency, the flight to quality means money comes to our shores, and you see our bond market rally, and typically you will see our stock market outperform other markets in these acute times of stress. So it's hard to differentiate what's happening just simply as a function of where is capital flowing versus this representing an kind of an evolving sense of what is the forecast. So it's a muddier issue right now, and I think a little more time is going to help us have better understanding.
Thanks.
But let me also say that we are passive in our equity portfolio. So, you know, this is sort of our discipline here is to not try to outperform in public equities, which is proven to be a very difficult challenge for a lot of investors. So, you know, but we know these types of things will happen over time, and we just know that occasionally our car is going to get a dent. You know, so I don't want you to think that we're going to be, you know, in our lab, you know, mixing the chemicals and coming up with a formula that allows us to anticipate and avoid any and all damage, you know, from a recession in Europe or anything like that, because that's just not our, you know, how we're focused on outperforming. So, okay, it's humility. So, other questions before I move on to performance? All right. So let me start with a very familiar page. Here you can see that during the calendar fourth quarter, which is the fiscal second quarter, we earned more than 5.3% and outperformed our benchmark by more than 1%. So a great quarter both in absolute and relative terms. The net benefit payments in the quarter were $193 million. Bringing our total to $236 million thus far in the fiscal year. And you can see that our planned value rose to $41.6 billion at the end of the quarter. So looking at our performance framework, our returns outpaced both the policy benchmark and the reference portfolio during the quarter. And the portfolio structure and manager selection impacts were both positive during the quarter. So let's look at our asset class performance.
Yeah. What is Lawrence doing here?
So I've heard a question. So public equities rebounded very strongly after a negative quarter in the first quarter of the fiscal year. Our private equity portfolio has continued to build on a very strong start. Very strong, and is now up almost 19% over the 6 months. I also want to point your attention to real assets. Last time I pointed out that the benchmark for our real assets portfolio, which is a core real estate benchmark, had its biggest quarterly return since the 1970s. It has followed that up with an even bigger quarter. Not an easy feat to outperform the benchmark this quarter, but the strong performance in that portfolio was coming from our listed exposure specifically to REITs. And finally, toward the bottom of the page, our portable alpha hedge funds have continued to outperform cash rate for us, so that portfolio is doing exactly what we hope it will.
Jeff, quick question.
Yes,
Does core real estate benchmark, does the core mean publicly traded, so
No.
REITs.
Oh, I'm sorry. No, so it's
What does that mean?
a reference to kind of a risk level. So core real estate tend to be Class A properties in major markets, and they have high occupancy. I'd be happy to get this, and they the core benchmark is called Odyssey. Oh boy, this is open-ended, diversified.
You're almost there.
Core equity. ODCE, not Odyssey as in,
Odysseus.
yeah, not Odysseus.
Not that one.
Thank you for calling on my English major.
So it's less about how it's owned, but what is owned.
Yeah, it's supposed to be conservative real estate, that is, it does not have a lot of, vacancy, baked into it in big markets, the types of properties that can transact, very smoothly. And the benchmark constrains the amount of leverage that can be. So if you we think of real estate as having kind of three risk flavors: core, value add, and opportunistic. And that is, as I move left to right, that is moving out the risk continuum. So, and Eric will be presenting to us in a little bit, so I will defer to him on how he would like to characterize value add and opportunistic, but we're going to hear some discussion of value add opportunities.
Thank you.
So, excuse me. So our 3-year returns now are ahead of benchmarks in 4 of our 5 asset classes, the exception being private equity. And near the bottom of the page, again, you can see that our Portable Alpha implementation has added value. All in all, on a 3-year basis, the plan has outperformed its benchmark by almost 1% annually. At our December meeting, you may recall I asked you to think of each of the circles shown here as links in an attribution chain that collectively explain how our performance differs from our policy benchmark. I'm going to walk through these, and I'll be as efficient as I can. This is how we think about those linking together. Our policy benchmark earned 5.7%. Allocation impacts added a little more than 1/3%. Implementation impacts had very little, positive 1 basis point. And our manager selection carried the day and improved our returns through the first half of the year by 93 basis points, bringing us to our ending plan value. So let me give you a little bit of additional detail for each of these.
Can we go back?
Yes, sir.
Kind of thinking broadly, and I apologize for all my questions.
Is this the page?
Yeah, that's fine.
Okay.
So this is going from policy to actual return.
Yes.
So, which is great. What it's not measuring is the value from diversification.
Correct.
Okay, so,
Correct.
but if I go back to a couple pages earlier,
I'll meet you back there.
that seems to have the highest, fiscal year to date in 1 year were great, 3 years, not so great. That seems, those numbers are a lot bigger than the other two.
Yes.
And so I guess I was just thinking about this when I was reviewing this, that this analysis from policy to return is great, but there's this other component that we can't forget about, which is the value of diversification, which seems to fluctuate. At least there are higher numbers, and it fluctuates a lot.
It absolutely does.
Yeah.
Yeah, and think of that as it is 2 listed benchmarks that comprise that reference portfolio in the top left. So looking at how a diversified portfolio does against these 2 public things, these are going to be very volatile, and when we get to the risk slide, I'll show you that. So there's a certain amount of this that if we focus on that, I think we're gonna be kind of tuning into the thing that we knew was gonna be really volatile over short periods of time. I wish I could just spend time on the reference portfolio, not over these really short periods of time, but over longer periods of time. Because if you think about it, the commission makes that decision for what is the policy portfolio.
Yes.
So that is something that I think is best evaluated really specifically over long periods of time. But we make investments and you have oversight. So what I'm trying to serve up to you is an articulation of how is it going, how well are we implementing what you told us to do. So I haven't really necessarily laid it out that way, but I want you to have all of this. But at the end of the day, you know, my team is asked to invest and manage the assets of the trust in a way to deliver the portfolio that you all approve within the constraints. But I want to make sure I'm giving you a sense of how well are we doing. And it's not always good news.
No, I appreciate that. That ties it together. I just,
Yeah.
That was excellent. Thank you.
So I think that box is always going to be really volatile, and over short periods of time, I just don't think there's a lot of useful information.
Mm-hmm.
We should be paying attention to it, absolutely. And if there's a desire to hear more, I can certainly calibrate my performance update to, you know, do a little more on that front. But the spirit of this for me is I'm trying to make sure you have, you know, useful oversight in terms of the actions that I'm taking and my staff is taking.
Okay,
So,
awesome. Thank you.
Yeah, and I think too, like part of that also is, you know, we're trying to anchor in the policy portfolio, we're trying to, you know, set up the discipline where we anchor ourselves in that for, you know, 4 or 5 years at a time, right? So, which is you know, and we just, at this point, we don't necessarily have as long a run of data to show the comparison between the two because we adopted it, you know, back in 2020, right? We're showing you shorter term data, which is likely to create the most amount of noise between those two portfolios. But if we stretched it back over time, you would see a lot more, you know, you would that noise would kind of filter out a lot more.
Jeff or Mike, this is Ed. I have a question on the policy aspect.
yes, sir.
In the past, there was some criticism that the policy benchmarks were constructed so as to make the actual performance enhanced. So how are we putting that those policy benchmarks together now?
So, well, great question. First of all, it is on the advice of our consultant that the benchmarks are set. One thing Mike and I have spent some time on is really drilling into our private equity portfolio over the last several years, but we've started to pay more attention to how it's benchmarked, and I can assure you that I'll let you say it. It sounds too self-serving.
Yeah, well, I don't know if it sounds it's much less self-serving if I say it, but we've seen some interesting benchmarks, as Jeff alluded to, that would, you know, there's basically an all, and we don't, given that we don't subscribe to it, I don't want to, you know, necessarily say what it is, but it's basically a benchmark that tracks the private equity of all defined benefit plans and the returns of all defined benefit plans. And the 1 year, there's about a 18% difference or more in the return of that benchmark versus our benchmark, 18% less. So, because our benchmark is giving you in essence, the opportunity set is if you could, you know, if we could structure our portfolio in a way where we gained that we had the same portfolio basically as a portion as to what the opportunity set is between, like, you know, buyout and growth and venture. But
we owned all of it.
If we had all in the same weights as the benchmark, right? It's the same weights that it appears as the benchmark. So that's what we're showing you. That's the benchmark that we're using. But if we looked at kind of and this is, if we looked at more of a peer benchmark as to what everybody else actually has and use that as a benchmark, then there's a significant amount of difference between those two currently. Now, I mean, that could obviously go a different way, but the year difference is about 18%. So that peer benchmark is about 18% less. So, I mean, the point is we're not definitely by using that in particular, that benchmark in particular, we're not lowering the bar, we're raising the bar. So,
Yeah, Ed, I don't see anything easy here, in terms of our benchmarks.
Yeah.
We made a decision intentionally in 2016, I want to say, to start making it harder. And when we adopted our private equity benchmark, again, I don't recall exactly when that was. That was very much a step up. And we're having to rise to the occasion in order to be competitive. And I'm proud of the work that Derek Connor and Evan Affinito are doing with their team, because we've come a long way. We're not there yet, but those guys have done a fantastic job making us more competitive with a very difficult benchmark.
And as you can see, I mean, obviously, there's still work to be done, as Jeff just alluded to, but, we set I feel confident saying we set ourselves a more difficult challenge than we had previously. And we're doing the types of things that get us to the point where we can rise to that challenge. And, in private equity, that's really when we think about persistence versus magnitude and how asset classes deliver those, persistent return versus magnitude of return, that, portfolio is, that is the purpose of that portfolio is to deliver the magnitude, to deliver.
Mike, just to be clear, I think you said we get recommendations from the consultants on the benchmark, but ultimately we set the benchmarks?
That is correct. Yes, sir. Yes, sir. And they're enshrined in the SIOP. Yes, sir. So the commission sets the asset allocation and also the benchmarks for the asset classes that make up the asset allocation. So that's not us doing that.
Has there been much differential between the consultants' recommendations and our ultimate sets?
No, sir. They match. So, but the commission adopted the benchmarks that the consultant recommended.
Oh, okay. All right.
Yes, sir.
Okay. All right. So let me show you the meaningful allocation effects here on page 133. So just to reinforce how this works, all of the numbers that you're seeing here add to the 36 basis points at the bottom. So the only really significant allocation impacts are coming from being overweight private equity, which has been the top performing asset class, and being underweight bonds, which has been the bottom performing asset class. Moving to implementation effects, this shows us there have been two very, very meaningful primary impacts so far, but they have roughly offset each other. First, the decision to employ portable alpha, and again, we are measuring that by comparing a hedge fund index to the cash rate. So hedge funds have outperformed cash, which is, you see over here on the right-hand side, contributing positively 18 basis points. But I have made the decision to have infrastructure inside our real assets portfolio, so I have cost us 22 basis points. But again, overall, so far through 6 months, we have a positive 1 basis point of impact from implementation.
How is infrastructure costed by having it in the real asset
Because
portfolio?
it is underperformed. So the math on this is we compare
Oh, it just underperforms.
infrastructure
Okay.
to that benchmark that has been
Okay.
bananas so
That makes
far.
sense. Yeah.
So just having infrastructure instead of more real estate is effectively the thing that has hurt that portfolio. And again, that's my call on how we structure that portfolio, so.
Can you go back to, please? I'm sorry.
This one?
Yeah, so private equity, top right, you said we're overweight private equity?
Overweight, and it is the best performing.
Yes, yes. So I think our target is 9%.
Yep.
Private equity, and it looks like on page 5 of this slide, we're at 12%?
Yes, sir.
Roughly?
Yes.
Okay. The only reason I wanted to clarify that, it seemed like I have heard or read something, and maybe it was outdated, that we were still not. I know a couple months ago, or 6 months ago, we were talking about, you know, we need to we've always been behind, and then all of a sudden, we're at 9, and now we're all the way up to 12.
Yeah.
So
yeah.
it just seems like it's changed a lot recently.
Yeah, well,
And returns did that.
Yeah. One year return, 49.2%.
Okay. I'm just trying to make sure I get it straight in my head.
Yeah, we were not expecting that.
Yeah. That's pretty much results not typical, right?
Yeah.
Yeah.
But absolutely. I could do a little bit of a study next time maybe on how that path of migration has transpired. But it's been a function not only of very strong returns, but we have we've been very fortunate, that we structured our co-investment program in a way that resonates with general partners. So we've been seeing a tremendous amount of co-investments and very high quality co-investments. So we've been able to deploy a fair amount of capital above and beyond what our funds get us, but then also to have this almost 50% return over the course of the last year. That's just catapulted us very much north.
All right, thank you.
Of where we expect it to be.
Well, yeah, and two, you think about like the relative performance too, when that's earning 50 and the other parts of the portfolio, which, for the over the 1 year time frame, we're doing well, but nowhere near as good as that. That's going to compound that effect as well as to how much of the percentage the private equity allocation ends up being as well. So, the relative performance makes a significant amount of difference too between the asset classes as to how much shelf space they're going to take up.
How frequently do you rebalance to realign? Because, I understand how the returns.
We can't rebalance private assets, private equity, certainly,
right.
Very easily, because then we begin to incur
right, because there's a
lot of costs.
Right,
to
a
do
longer
so.
time horizon on those.
Yeah.
But what about the rest?
The rest of the portfolio, we rebalance quarterly. So right now, what we're having to do is rebalance other things around this kind of
because
structural overweight to private equity. So that's, and that's frankly, more recently just been met with an underweight to bonds. But we're contemplating evolving our approach on that to potentially share that underweight in our equity portfolio as well.
Before we move on, Jeff,
Yes, sir.
I'd like for you to speak to the effect that the time and talent and resources that we have here with staff moving to the simplified portfolio model that we have, the fact that we've gone passive on our public investments.
Yes.
Is what we're seeing, at least in part, a result of the increased energy and focus on the private markets? Is that some of the juice that we're seeing from that squeeze?
Well, first of all, yes. Can I quantify it? Not as easily.
Okay. I understand.
But we have, versus where we were 3 years ago, where poor Derek Connor was essentially a one-man band, we have added 2 people to our private equity team. Unfortunately, we lost one of them last year, but we're going to be saddling up and expecting to put more resources in that team. What you're seeing elsewhere is, let me just move back here to this page. When you look at our private debt portfolio, that was the fantastic work of not only Alan Bavard, who's running that for us now, but Steve Marino before him. They really turned that portfolio around. And real assets, this is, Eric Ravelli, who you're going to see. Eric's delivered a portfolio for us that's just continued to perform very well against his benchmark with the most consistency of anything in the portfolio. So Eric took on the infrastructure exposure and has Kevin Matherly, who used to work for Brian, running our public equity. So to your point, we very much moved resources around in order to focus on the things that are going to really drive our outcomes on a go-forward basis. So I hope that's responsive to your...
Yep.
Okay. Let me end our attribution here with the manager selection impacts, and the story here is largely a very strong one, with the lion's share of the outperformance coming from private debt, portable alpha, private equity, and bonds so far this year. And when we come back to our return bridge, that helps hopefully explain how we get there. This is supposed to be a heat map. We call it a heat map, but heat is cool on this. So the heat, the outperformance is in blue and the underperformance is in red. And we try to calibrate the intensity of those colors to match the magnitude of the outcomes. And as you can see, we've been very fortunate so far this year with frankly, only my decision to include infrastructure in our real assets portfolio working against us thus far. And in the interest of managing expectations on a go-forward basis, this page, please do not expect this to look like this all the time. It's great when it happens.
Oh, no.
But
We've gotten used to this now.
This is sort of like famous last words time. This doesn't happen very often, where so many different parts of our portfolio are working to great effect. The notes that you see here relate to the portfolio's positioning and recent activity. It all flows through to the exposures that you will see on the next page. But if you asked me to highlight two important things, I would first point you to the top, our public equity portfolio. Even though what I'm about to show you does not look like we completed a successful rebalancing, we did after we got through the first of the year. We tightened it up, and we did remove our overweight to public equity at the end of the quarter. And then the second thing that we've already talked about, it really just is our private equity portfolio continues to grow as not only a function of the strong returns, but also the fact that we've been able to deploy nearly $800 million over the course of the last 3 years in co-investment that has no management fee and no carried interest. So we've just really, that is helping turn our private equity portfolio around, and I want to take a minute to point that out. So let's look at compliance, and you can see here each of our asset classes is within its allowable range, so we are compliant in that regard. Our most significant overweight private equity is 3%, and our most significant underweight to bonds is 4.5%, which you can see in the third column of numbers. Section 5 of the AIP SIOP combined document includes a provision whereby staff will notify the commission if our collective exposure to private equity, private debt, and private real assets, so that would exclude listed real assets like REITs and listed infrastructure, if those assets total more than 30% of the portfolio. I do think it is worth noting that if we add up all of the targets, the target weights add to 28, so this is a very tight notification threshold. And if I were to take any one of the three private asset classes: private equity with a target of 9 and an upper limit of 13, private debt with a target of 7 and an upper limit of 11, and real assets, which has upside of up to 6%. If I pushed any one of those up to the top of its limit, we would trigger this notification requirement. So all that to say, I don't treat this 30% as a limitation, but rather as it's codified in the AIP SIOP as a duty to notify you. So I just want to make sure that I'm, sharing this with you. And also, given that all of these assets, or not all, but most of these assets have very long investment periods, I can predict with, I would argue, almost perfect clarity that I am going to be making giving you a shorter version of this same speech for quite a number of meetings ahead. So I just want to make sure I'm pointing that out.
Jeff, so we don't include hedge funds in private markets for this calculation?
No, hedge funds are more liquid. This is in the AIP SIOP. It is specific. I think I don't know if I read it verbatim, but it is, quote, staff will notify the commission if the collective exposure to private equity, private debt, and private real assets exceeds 30% of the total plan assets.
Okay, well, that's pretty clear. It doesn't include it, but I guess generally, I think a hedge fund is private investments. Well,
I would challenge you on that just insofar as, Brian, how much of our hedge fund portfolio would you say we can liquidate in 6 months? As an
6
example?
months? Probably 75%.
With no, bid-ask spread that we're losing money to get out.
Yeah, unlocked. A lot of it, and I would say even a big portion of that is managed accounts, which we have liquidity. It could be up to daily.
That's pretty unique for private.
I think it's more, if you think about it, because the underlying assets, because what's comprising the underlying assets, I think probably alternative is better than private because it's not necessarily in private type assets, right? I mean, a lot of what the underlying exposures are,
Stocks and bonds,
and just different, it's just different structures rather than,
Okay.
But there is a degree of illiquidity to it.
Okay. So as it relates to risk, I'll save some time here. This is little changed from last time. I will just remind you that we did switch for reports starting this fiscal year to a 3-year model from a 2-year model, and I'm sure that that is very controversial, and we want to spend a lot of time on that. But the reason we did that was because we're showing you 3 years of trailing performance, and we just wanted to make sure that the risk statistics lined up with the performance that we were showing you. And then I will conclude with this slide, which is showing you how our forward and trailing risk statistics line up. And we can see that the actual volatility observed in our returns and our framework portfolios that we measure, which are on the bottom of the page, are lower than the reference portfolio, but the way we forecast and model risk a priori is at the top of the page, where we don't really expect that having we want to make sure that we have a healthy view of risk, regardless of what we have seen recently. So we are modeling risk in a way that I think best serves us from a expectation standpoint. So let me pause there and see if there are any questions.
I wonder if you could just clarify briefly how we are going about using this portable alpha process.
Sure. So Ed, let me back up here on the slides. So the way that I can describe it to you, Ed, is, you know, the commission sets the policy benchmark. I have an ability, but not an obligation, to employ portable alpha as an additional exposure. So the way that we are executing that right now is, since we have bond yields that are very low and cash rates that continue to be even lower, we are exploiting that by having a chunk of our bond portfolio be synthetically implemented, which in essence confers to us a liability equal to the cash rate. Then we take the assets and we invest in low beta hedge funds that we do not want to see meaningful market correlation inside. And if those hedge funds outperform that cash rate, then we are generating an uncorrelated source of additional return. So that is how we are doing it, and it is roughly 11% of the portfolio at the end of December. So let me pause there and see if I've responded to the spirit of the question.
Yeah, I just wanted to be clear. So using portable alpha now involves the low beta hedge funds, but that does not imply that going forward that there would be under different conditions that we would be employing hedge funds at that point. Is that correct?
Correct. And I'll explain to you my thinking on this. When interest rates return to levels that allow us to frankly feel better about having 26% of our portfolio in investment grade bonds, when we get to that point, then I think the value of the utility to us of having a portable alpha implementation needs to be revisited, and I would expect that as rates rise and as the entire curve shifts higher, that we will begin to work down our use of portable alpha. Not saying it would go entirely away, but it would no longer have that same utility function to us that it does today. You know, for the most part, lower rates make it harder to run a pension fund, but if you can exploit the fact that low rates mean a low cost of a liability, now you can have a spread over that be the benefit. I would much rather be doing, well, let me say that this way. That is one of very few ways that we have to turn low rates into an advantage for us, if I can put it that way. So I don't know if that necessarily responds directly to the question.
I think I just wanted to get straight what we use portable alpha for, and I think you've explained that.
Okay, great. Thank you for the question, Ed.
Yep.
Are there any other questions?
If there are no more questions for Mr. Berg, I'm going to suggest that we take a 10-minute break at this point. Are there any objections to that? The clock I'm looking at says 11:04. Let's get back together at 11:14. Everyone, thank you.
Sounds good.
Next up on the agenda is the strategic investment topic presentation by Makita. At this time, I'm going to turn it over to Mike.
Yes. We have this is the time of the year where the commission reviews the annual capital market expectations from our general investment consultant, Makita. They are on the line, I believe, and they will go through a presentation on their capital market expectations. And, you know, not to steal any of the thunder, but as we have seen some improvement in those year over year. So I'm sure they'll note where that improvement came from and how they give us a little bit of a primer on a reminder on how they calculate their capital market expectations, but I will turn it over to either Ally or Leroy, whoever's going to present. And do you guys need us to click for you, to click through?
I think so. I can share the presentation on my screen if it's easier for me to drive. Otherwise, I can just refer to page numbers.
Well, let's just go ahead. Why don't we just refer to page numbers, and then and we can drive, and then that way we won't.
It's a lot of responsibility.
Yeah, I mean, Jeff's in charge, so it may or may not work. Let the record reflect that Jeff exceeded his responsibility to a potentially more capable. We just increased our probability of success.
Outing me for my attention span.
Yeah,
Great. Well, thank you and good morning, everybody. Leroy and I hope to have the opportunity to meet you all in person at a meeting coming up soon, but we hope you're all doing well, and we look forward to the opportunity today to talk to you a little bit about our capital markets assumptions and what goes into creating them. I'm going to kick it off with just kind of our methodology and how we go about building our capital markets expectations, and then I'm going to turn it over to Leroy to get into details on what deviated over the past year between 2021 capital markets expectations and now the 2022 expectations. So I will start on page 2 of the materials and just highlight that each year in January, we produce these capital markets expectations, which are driven by a number of factors, including interest rates, valuations, credit spreads, and a number of other factors go into building out our return expectations, our standard deviations, and our correlations to each asset class. And as you know, 2021 was a great year. I think your return overall was 18.7% for the calendar year. And a lot of our other clients also benefited from the positive results of riskier assets in 2021. So the corresponding impact of that, I think you would expect overall to see generally your return expectation come down as a result of heightened valuations. But you kind of saw the inverse of that. So you went from an expected return in your portfolio of 6.56% to 6.71%, which was largely driven by the fact that we anticipate bonds rates to rise in the near term, having a positive long-term impact on the return being generated from bond portfolios. Conversely, I think if we look at our shorter term period, and we'll talk about that, how we consider a 10 and 20-year horizon when building our capital markets expectations. Some of our expectations for riskier assets over the shorter term period have come down in light of where we see U.S. equity valuations today. So if you jump ahead to page 3, here we just highlight what we're seeking to do. So obviously, the largest determinant of your overall success is your asset allocation. And so regularly we're using mean variance optimization, or MVO, as the starting point to determine the appropriate asset allocation and build out a diversified portfolio on your behalf. And the 3 key variables that go into that are returns, standard deviation, and correlations. And so we use both quantitative and qualitative methodologies to determine the appropriate returns for each asset class, and we'll go into that in more detail. But we recognize some of this is a little bit of more of an art than a science in light of the fact that there's a lot of projections that go into this, but we ground a lot of that using historical data as well as reasonability checks that we do amongst our investment committees internally and using external parties. So the next page, page 4, just highlights how we go about determining what asset classes are appropriate. At this point, we have 97 different asset classes that we're building these models or these inputs for, so returns, standard deviation, and correlations for, to determine the optimal portfolio construction. And most recently, we've added 4, 2 in private markets and 2 in public markets to further build out the robust nature of our asset class projections. Starting off, as we kind of build out these return expectations, we start typically with a 10-year forecast. And on page 5, you can see the key factors that contribute to the various asset classes return expectations going forward. And as you'd expect, things like these are largely driven by dividend yield, GDP growth, and valuation. while bonds are driven by the yields, default rates, recovery rates on the bonds, and then some other more qualitative attributes. So we use all these different factors to build out the expected return and use them within a model that we'll show you on the subsequent pages. But page 6 just kind of displays the predictive power. So some of these factors are more helpful in building the expected return for a portfolio than others. And you can see that based on the R-squared in the top of these portfolios, which is the coefficient of determination, and higher numbers or higher R-squares indicate that these factors for yield to worst, for instance, are better predictors of future returns. So when you look at these blue dots, they reflect real life scenarios when the yield to worst was at these various points, what the corresponding forward 10-year return is. And you can see generally, as indicated by that black line, it's been a strong predictor. They're bunched all together kind of tightly around that tight line, giving you a relatively high R-squared and indicating that the yield to worst is a really strong predictor of forward 10-year returns for bonds. That said, as you get kind of looking at cash, for instance, because of the reinvestment, the frequent reinvestment rate is less of a predictor. And then cap rates for real estate is also less of a predictor. Valuations, as measured by the cyclically adjusted PE ratio, is a reasonable determination of looking at return expectations, but obviously not the only one that should be used, particularly in light of the R-squared or the coefficient of determination being around 0.54. A note too that we find ourselves today kind of in the top left corner, as you'd expect, of the Shiller cyclically adjusted PE ratio in the kind of mid to high 30s. And so that indicates to us that short-term returns for U.S. equities are likely, in short-term, the next 5 to 10 years, are going to be much lower than they will be over long-term periods, like 20 years, in light of high valuations and purchasing at high prices and high multiples. If you look to the next couple of pages, I won't bore you with like the exact formula that we're using to build out these 10-year return expectations, but we have included examples on page 7 and 8 for equities and bonds. And then we talk in a little more detail on page 9 about how we go from the 10-year projections to the 20-year projections. And so the 20-year projections are more reliant on a risk premium approach. And so we start off by determining what the appropriate risk-free rate will be in 10 years. And that has come up, obviously, in light of the expectation that rates are going to rise. And so that's made it a slightly higher starting point over the 10 to, or the 11 to 20 year period. We then add a risk premia for each asset class and obviously try to maintain some consistency as we think about the risks associated with various asset classes relative to one another. And finally, this is where the qualitative adjustments come into place. We do incorporate some mean reversion into our expectations, and then we go to our investment policy committee and really scrutinize the outputs of our methodology to determine whether or not everything makes sense given the market environment, given where we find ourselves today, and any extenuating circumstances that may be influential on return expectations. So that's how we go from a 10-year and then and progressively to 20-year expectations on all of our asset classes. And I'd note that every year in August, typically, Horizon's actuarial firm publishes a study, which I know you guys have included in your past materials, but is typically a good proxy. I think we have it on page 17, and Leroy will get into it in more detail for 2021. But it generally gives us a nice reasonability check, and also nice reasonability check for you guys to know that our asset class assumptions are generally fairly in line with peers. Some are slightly more aggressive, some are slightly more conservative, but this methodology is generally consistent with what we're seeing as the output from the broader institutional consulting industry. On page 10 is the final page I'll cover with respect to our process, and then I'll turn it over to Leroy to highlight a few other details as it pertains to the 2022 expectations. But I'll note that we use trailing 15-year standard deviation as well as skewness when we're determining the standard deviation that we should consider for each asset class. But obviously, in some cases, that's fairly limited if there's a shorter, reliable return stream associated. So sometimes we need to adjust that to account for shorter tenured asset classes. In addition, we also must account for the smoothed returns in private markets, and we do that as we evaluate standard deviation. And then we also use trailing 15-year correlations as a jumping off point to build our correlation tables for each asset class, and again, accounting for the smoothed impact of some of the private markets assets. Generally, we don't see huge shifts with respect to correlation or standard deviation in our annual asset class assumptions. You see more of a reflection and change based on the valuations and things like that that impact return. So with that, I'll pause, see if there are any questions. If not, I'll turn it over to Leroy to get started on page 11.
Okay, no questions. I'll jump right in. And as Ali said, my section will primarily cover the year-over-year changes for the underlying 90-plus asset classes. I will not go over all 90 of those asset classes. We'll talk a little bit about the horizon, so we have more of a peer reference for what we're doing. And then we'll talk a little bit about the adjustments in the RSIC portfolio. But by and large, one of the factors to keep in mind is that there's a, as Ali mentioned, sort of the heart of this is our mean variance optimization. There's a reversion to the mean component that goes on there. As you've seen, in spite of the fact that we just ended the quarter, which was a big risk-on quarter, it was a good year for equity markets, 2021. The numbers went up, and for those factors, largely we'll go over those in a little bit more detail. But as points of reference, if you look back to 2019, that was a year where our numbers went up considerably, because at the end of 2018, you may remember that fourth quarter, especially December, returns fell off a cliff. So there was an upward revision that happened there. And conversely, if you go back and you look at 2021, there was a downward revision because 2020, outside of March, where you had that month where you had both a bear market and a bull market for the S&P 500, the only time that's ever happened, it was a really good year to be invested in the equity markets in general. So there was a downward revision that occurred here. But here, we'll start here with the rate sensitive page in terms of looking at the underlying asset classes. You get to see that inverse relationship that happens with rates and prices. When you're looking at bonds, rates go up, prices come down, yields go up as a result of that. So as you look at these numbers here, year over year, investment grade bonds went up about 60 basis points in terms of our expectations based on the higher yields. And if you move further down the page and you look at tips, both the short-term and the long-term tips, you'll see an improvement of 50 to 60 basis points for there because of the higher inflation component. So this higher inflation component will play a role throughout the portfolio, as well as more to certain asset classes. And Jeff focused his part of his presentation today on the advent of inflation, the CPI at a number that it hasn't been at for decades. That's something that we'll look to see the overall impact of the shift in rates on the underlying asset classes. If we move over to the credit page, you will see here those higher yields that I just mentioned play a role here. The greatest numbers here in terms of improvements, and all of these are improvements or flat, you'll see that emerging market bonds in the local currency up 70 basis points year over year, and distressed debt up 70 basis points also. And the underlying factor for that, the driver for that, both of those are higher yields. On the next page, equities. This is an important page. Jeff talked about the importance of private equity, but if you look at this page here, this is really the growth engine for your portfolio. So looking to do asset allocation without including private equity and emerging markets will hamper your meeting lofty return objectives. So those are very important factors, very important inclusions when you're looking at asset allocation. But I should also say, when Allie referenced this on one of our pages, we have a conservative approach when it comes to these assumptions. And you'll see when we're looking at private equity and hedge funds, those are places where you can have alpha driven by managers. We don't include that here. But on the flip side of that, we do know that these alternatives are a very expensive group to have in a portfolio, so we do net out fees here. On this page, you have one of the few areas where there is a downward revision, and that's frontier market equity. You'll see that going down 20 basis points from 8.9 to 8.7. Still, that's a very high expected return. And in terms of the math, we do want to include that in the portfolio. But on average, if you move down the page and you look at private equity in terms of buyouts, growth equity, and venture capital, these are at 10% or north of 10%. And typically you're looking, and as Jeff said, the manager selection has improved greatly in our program here. These numbers here are median numbers, and there can be, unlike with fixed income, when you're looking at quartiles, there's a very small compressed differential. When you're looking at private markets, that differential is wide. And in this case, it's been 40 to 50% better than what the median expectation here is. But that's why there's a pressure to make sure that you're making the right picks for those managers and that you have a seat at the table for subsequent funds that are raised by them. If we flip over to page 175, we're at real estate and infrastructure. You see here, there's one group that goes down, that's REITs, and that's based on lower REIT yields. But this is a group that's very inflation sensitive. So having these in your portfolio are very meaningful. You see infrastructure comes out flat, but by and large, you're seeing an improvement of the numbers in the inflation sensitive portfolio as well. On page 176, we have the natural resources and commodities. Once again, we have the inflation component here. These asset classes, underlying ones, are sub-asset classes within the natural resources bucket, especially on the private side. You will see there's one that takes a dip, and that's energy. And all of us know that from going to fill our tanks up with gas. Numbers at the gas station are up incredibly. And this energy factor was also something that we've seen existent this year, with emerging markets losing less than developed markets, US and developed markets ex-US. It's been energy. That's one of the prime drivers of there being somewhat of a capital preservation that's happening there. The biggest jump here are commodities. I fought tooth and nail to keep these in my endowment and foundation portfolios, and I've been more wrong than right on a quarter-to-quarter basis in terms of their inclusion. Now it looks like, I look like a genius for fighting for their inclusion, but this will be something, this is a definite inflation beta sensitive asset class, and one that's worth keeping an eye on. All right, so alternative strategies. Next page. All of these, the recurring theme through all of these are higher yields for the bonds, underlying bonds, and higher yields for cash. And so having exposure here also, as Jeff touched on, this is your ballast for correcting equity market. And we've seen bonds, when you have rising rates, don't provide the usual protection that you would see with the correcting equity market. So when you have that confluence of correcting equity markets and rising rates, it's great to have these alternatives in the portfolio. And all of these went up as well. So if we can move on to page 178, we can talk a little bit more about the peer comparison. So for the 10, we have both the 10-year and the 20-year numbers here. And I should say that our numbers are included in this survey. So in terms of skewing, we do have that effect there. When you're looking at us, by and large, there is that conservative, more bearish approach, theme-wide, but that's more persistent in the 20-year numbers. If you look at the 10-year numbers, you will see outside of core bonds where our numbers come in 90 basis points smaller than the 10-year average here. If you go down and you look at real estate, you look at infrastructure, those are two of the main ones that stick out. But overall, there are 7 of these groups where our numbers are actually a little bit wider, but the real estate and the infrastructure are the ones with the greatest 10-year disparity where you would deem us bullish. If you come over to the 20-year numbers, you will see where we have more of an upward thought process on this. It will be U.S. equity, emerging markets equity, and real estate. And real estate with 70 basis points is the greatest disparity there. On the flip side, cash. There's more of a cash is king, where the 20-year numbers are getting up to 2% return on cash. And we know that cash has been basis points, if not flat, forever now. But there's a meaningful disparity there when you're looking at the compression of what cash has delivered over the years. But you see that by and large, yes, over that 20-year time period, our numbers come out more conservative, where we're slightly more bearish than our peers. Page 179 gives you a good visual on how over a 10-year time period, very little has changed in terms of return expectations, but the risk expectations will move further out for these same asset classes. So what this tells you, and what we've seen by and large within the plan world, is that the return objectives, because of this low return expectation environment, those return objectives have come down to match that, to couple with what we would mathematically expect out of very well diversified portfolios. But this visual, it's just the moving up in risk and not moving as much up in return and moving out in risk is something that we keep in our sights in terms of offering our advice to clients. So last, we'll come to the portfolio itself. And if we look at the numbers on the bottom page, and Ali referenced this and Jeff referenced this as well, expectations from our 2021 to 2022 have gone up. The 5 asset mix is, it's a slight improvement. But once again, when you're coming off a year where equities have done so well, you would expect there to be some sort of downward revision in expectations. But the confluence of rates and all of the other great things that are going on in the market that have clouded factors have actually driven these numbers up. And the primary drivers, if you were to look up top, would be bonds, where we've gone up 60 basis points in expectation from 1.8 to 2.4. Private equity has gone up 90 basis points from 9.1 to 10%. And private debt has gone up 50 basis points from 6.8 to 7.3. And with real assets, we've talked about that with rising rates and inflation as a most likely advent that we'll have to deal with. Not as much a foe as Jeff referenced to pension plans, but still something that we'll have to deal with in terms of the underlying asset classes. Those are the drivers that help improve the returns. But if you look for the 5 asset mix with alpha, that's the only one that there's a slight change in volatility. That's an upward move of 6 basis points, very small move, essentially flat for the other 2 portfolios. But with this improvement in expected returns, the probability of achieving a 7.25 or a 7 flat have gone up 2% for the 5 asset mix for both the 7.25 and 7%, and north of 1% for the other two portfolios. Happy to answer any questions. Once again, this is a yearly exercise that we go through. I don't think I've ever seen as much debate over over a set of expectations, but it was a very lively debate across our different research groups and within our investment policy group, of which I'm a member. And you know, I'm fairly confident that these numbers, you know, these are 20-year expectations that we're looking at. And I'm hoping that we'll have, I'm like Jeff, I'm expecting a bumpy ride as well, but I'm hoping we have the ballast in the portfolio to deal with that. And we also have components of growth in the portfolio to enjoy any ride up that we see from the risk assets as well.
I have
Happy to
one
answer.
question about the terminology. I saw the reference to frontier markets and the public equity. Could you just tell me what that refers to?
Yeah, so frontier market is when you go one layer lower than small cap within the emerging markets. You said frontier, and what was the other one? I'm sorry, apologies.
Yes, just the definition of what frontier markets are.
Right, right. So it's more of, you know, I think most of these you will find a lot of frontier markets are in Africa and Eastern Europe. But by and large, it's a riskier asset class, but at the same time, it's more volatile, I should say. But at the same time, there's a higher, you're getting that much closer to getting to the volatility and the return expectations that you would expect for private markets, because you're going to give up a lot of liquidity by investing in these markets. And there's a lot more, I shouldn't say this now because I think the whole world right now is geopolitically risky, but you'll see a lot more geopolitical risk that occurs in frontier markets. So it's one step below emerging markets, and it kind of touches on to the smaller company sphere within emerging markets, frontier markets.
Thank you. As an example, the top 5 country weights in the Frontier Market Index: Vietnam, Morocco, Iceland, Bahrain, and Kazakhstan. So if that helps. That helps. Thank you.
Are those in the
MSCI Frontier Market Index. So they're not in our portfolio.
They're not in our portfolio.
Right. That I should have said up front, correct.
Have any of your projections going out through the years, as you've explained, taken into consideration or made any concession to what's happening now with the Ukrainian situation?
Well, when we look at the, interesting that you say that we will be, our research group will be producing a paper on what we think the potential impact of that is, but no, I don't think we can delve in and bake those into our assumptions. You know, we just got to a point where we were looking at where we had to, as you'll see, these numbers have gone up from 82 asset classes the year before to more than 90. So we do have some newer asset classes. So we have looked at things that have come up where we've seen a broad range. Jeff mentioned the divergence between growth and value. Back in 2020, we saw that happen. That was the first occurrence of that meaningfully, going back to probably the internet age, where you saw growth outdo value so much, and now you've seen a flip of that. And there was a dichotomy between the performance of large cap versus small cap. So we've gone in and we've become a little bit more granular within the asset classes, but looking at, the possibility of World War III and trying to bake that into our numbers, we did not do that, no. But that's something we talk about more on a tactical basis. Once again, these are 20-year expectations. These are strategic. As Mike mentioned, looking at our policy benchmark, that's a 5-year, that should be something we're anchored to for 5 years and not look to change every 2 to 3 years because it's more strategic, more long-term. Well, we look at these numbers, although, I gave you 2 examples, 2019 and 2021, where we did have a meaningful change because of what happened in the previous year, but we're looking at a much more longer time continuum when we're putting together these assumptions.
And also a note, so obviously in January when these were published, things weren't as severe in Russia and Ukraine as they are today. But one of the things that we were looking at then is China, and specifically how the CCP is going to impact, growth in China. And so we did think about that within the context of including a greater discount on Chinese growth, translating to earnings per share growth and thus to shareholder wealth when we were thinking about it. So we do try to think about the implications kind of geopolitically and kind of broadly across any specific asset class, particularly in emerging markets. That said, it's very rare that we revise these mid-year. We've done it twice now, but it's uncommon, but it's not to say that we wouldn't if things really started to severely infiltrate Europe or impact the broader economy outside of Russia and Ukraine.
Yeah, and in 2008 and 2020 were the 2 years we made mid-year revisions. We looked to do it in 2019, but opted not to. But as Ali said, that's always something that's on the table. Thank you, Ali.
So that concludes our presentation, but happy to answer any further questions. And if not, we appreciate your time and are always available between meetings if you want to follow up or if you'd like to talk about any of these topics in further detail.
Great, thank you. Any more questions for the consultants from Makita? None? Okay. Thank you very much, Ali and Leroy. Next up, we're going to hear from GRS Actuarial Consultants, Mr. White and Mr. Newton. The floor is yours, gentlemen.
Good morning. Thank you, Mr. Chair, members of the board. I'm Danny White. I've got Joe Newton, a colleague with me, who'll be co-presenting. We're the actuaries for the South Carolina retirement system. We'll cover, I call it 3 themes. We'll go over some high-level demographics, the 2021 valuation results, and Joe will be covering some projection or, projection information. If we go then, actually skip forward a few slides. There we go. So go over some demographics. I don't know if this has been discussed much at the RSIC, but kind of give you insight of who's covered by the South Carolina retirement system. So you essentially have 3 groups. This gives you order of magnitude of size and by type, and how that demographic has changed over time. By large, it's the public school employees, and you have state employees. Other agencies would cover municipalities, counties, and other authorities. So as it shows, you've got the relative magnitude. And demographics cover has relatively been stable from year to year. If we go to the next slide, some perspective on active membership in the blue line. So we have all the 3 groups combined, and then we have the retirees and beneficiaries. The red represents the number of people that are receiving benefits. So this is a sign of mature plan, as the lines are very much converged in our mind. To give you another perspective, this is a head count basis where you're counting noses, but if you look at it on a liability basis, the blue line, which represents the active employees, has about 20 billion in liability. If you look at it on the liability basis for retirees, it's a much larger base of the liability, about 33 billion. So retirees, while they're smaller in number, actually constitute about 60% of the total liability for the system. If we go to the next slide, we come out of COVID, there's some questions that come out, well, what's this do to mortality experience? So what we did was we pulled out the single largest group by gender and employee type, and that's your female educators. This is about a third of the retirees. And so it kind of gives you a perspective of what this experience was just this last year of 2020, the year ending FY 2021. So the green bar represents the expectation of the assumption. The bars is the actual experience as a mortality rate. So you can see where the actual experience of the mortality was higher than assumed in the further out years. I think it's also important to look at it on the table basis because that gives you a perspective. While there's not as many retirees out in those later ages. And also on a liability basis, this was about a $90 million liability gain, one of the largest seen for the system. But, in the context of a $55 billion plan, it's not a big variation, in aggregate. But it does give you some perspective on the what if and how this disease has impacted the system on a financial basis. And if we go to the next slide, we're looking at cash flow. So the solid bar represents actual historical cash flow. We have the red represents benefit payments, distributions outside the system. The blue represents contributions, member contributions, and employer contributions combined coming in the system. Employer contributions account for about 2/3 of the total. That small spike was a Terry program closed June 30, 2018. This was a known and an expected occurrence that the RCIC could plan for in terms of cash flow needs, liquidity needs. And then we have the projection going forward in the dotted line. So a couple notes here. The SCRS plan has a COLA or benefit adjustment feature to it, but it is a fixed COLA. It's not tied to inflation. So while we're in periods of high inflation, the high inflation doesn't directly impact the cash flows coming out of the system, unlike some other systems that may have a COLA, based on actual change in CPI. So this is not a variation or a risk to SCRS. And then on the bottom, the blue line, you can see where the contributions are merging with the benefit payments, the net cash flow. And then you can see about after 2024, that trajectory changes. And what that is right now we're in a state of where payrolls, increasing or projected increases assumed. And then we also have the contribution rate continues to increase for 2 more years. And then what happens is after 2024, the contribution rate reaches a plateau. So increases after that date are projected, or the source of that is assumed growth in covered payroll, which is your revenue source. If we go forward, actually 2 slides, so we'll cover the 2021 VAL results. When we're going to show a year-by-year comparison, 2020, 2021. When we talk about, and as we note through differences, no changes in benefits, although there were updated demographic and economic assumption changes. PIPA board adopted updated demographic assumptions. The assumed rate of return is in state statute, and that was decreased from 7.25 to 7 as a result of recommendation by the PIPA board and RSIC. The big headline, of course, here is the fantastic market return for FY 2021. In terms of, just a much needed improvement in the financial condition because of this. The assets were almost $6 billion more than expected for SCRS and $1.1 billion more for PORS. To kind of give you a perspective of what this means is that's equivalent to about 3 years of employer contributions, just for having returns up and above what was expected. So the expectation is a 7.25 for that last year. And so anything more than that is a true benefit to the system financially. As we go through on the next slide, I'll give you a forewarning, and that is on the assets, this is a calculated asset value on the second line. It's not a market value, so it's going to take out some of the inherent short-term volatility, and that's by purpose of the design, so we're not reacting one way or overreacting one way or the other, in terms of the financial metrics and impacting cash contributions. And again, that's by design. Joe will give you more information on that. In terms of the actuarial accrued liability, when it increased, the assumption change gets immediately recognized. It was about 1.6 billion for SCRS. The assets gains are recognized at returns more than expected or less than expected, or 20% per year in the current and next 4 years. Note on this, so that's why the relatively small impact on funded ratio. Contribution rates are set in statute. The important note here is this calculated funding period. Statute also has a maximum permitted funding period that was at 30 years when in 2017 that walks down or steps down is 26 years as of 2021. So if there's a period of time that the calculated funding period exceeds the maximum in the statute, the employer contribution rate has to further step up. So that's a kind of a back wall or backstop to make sure that the contributions in statute are sufficient. Plan. If we go to the next slide, this is another information that's going to be in the PBIS annual report, which also translates to what employers report on their balance sheet. So in terms of accounting of what has to be done, it's actually on a market value basis, although the accounting terms don't call it the market value of assets, but the planned fiduciary net position is market value of assets. And so what's on the balance sheet right now for the state is about 25 billion. Actually, they get about a third of it. The other 2/3 goes to the other participating employers in SCRS. And so while we have it calculated for 2021, there's a kind of a lag before it actually gets reported or moved to the participating employer's balance sheet, which will actually be June 30, 2022. But there they get to see an immediate impact or immediate benefit of a reduction in their share of the net pension liability that they have to take ownership of, on at least on their accounting statements. So with that, I will turn it over to Joe.
Great, Danny. Thank you, Danny. And we're going to move here into the next couple of slides. We're going to talk some projection information. Danny's talking about the demographics and kind of what the snapshot looks like, but these next few slides are going to begin to project that forward. This first one is, maybe you could label it the plan, or when we say the funding period, what do we mean? How is this going to work out? The red line here, you have 10 years of actual history in the accrued liability. So that represents, as of the valuation date, how much liability did all the members, if you add them all together, total up to. And so when it's dark, when it's a full line, that says actual history, and then once it turns to dashes, that's then our projection, assuming all assumptions are met and headcount remains stable. And so you can see here the red line goes off into the future, growing at a pretty consistent rate. And then below it, you have your asset values. You have the market value, which is the green, and every time there's a valuation date, that's the diamond that you see. And then the blue is the smooth value of assets, or actuarial value of assets, that we use in our valuation process just to smooth out the fluctuations in the volatility of the financial markets. You can see in 2012, as we came into this process, we were having to deal with the financial crisis and recognizing those losses. But in general, the two lines should just kind of hover around each other, but the blue line should just be a smoother version of the green line. One thing that's interesting here as of 2021 is how much of a spike up the green line represents compared to that smoothing value. And in fact, if you look at the whole 10-year history here, this is the first time the market value has been above the smooth line for during this time period. So this is a very, we'd much rather be in that position. We'd much rather be on that side than the other side. But all of our financial information that we report is on the blue line. And so you can see how that projects out into the future and does catch up with the liability out there around 2035, 2036. And that's when the unfunded liability will be paid off, because basically the difference between these two lines is the unfunded accrued liability. So the next slide is going to talk about what those deferred gains that sit there on the books right now. Can we go to the next slide? What that buys us going forward from an expected return basis.
Joe, can you hear us?
I can.
I think we should be on slide 195.
One more slide.
Okay.
Thank you.
Sorry.
Can you see that, Joe? You want me to jump in?
I just see slide 13. Did you go forward? Okay. Well, if you guys can see 14, then that's great. But what you have is a red line and a blue line here. The blue line is the smooth value as of the valuation date. So all the values that Danny talked about a while ago, it's all based on the blue line. And that projects out in the future. And that's the one we need 7% on going forward. Our valuation assumption is that we're going to generate 7% returns going forward. And our valuation assumption only relies on that smooth value. The red line actually starts from today's market value. And so you can see right now we have about 10% of a buffer. We have deferred gains in our smoothing mechanism of about 10% of the asset value. And going forward, what that means is if we get 7% from the blues line's perspective, the question is what return could we get from a market perspective and have those converge over time. And so basically this is saying, hey, over the next 10 years, that as long as we get 5.9% return over the next 10 years, these two lines would then converge, which makes sense, right? We have a 10% buffer right now, 10% divided by 10, about 1% a year. So as long as we get around 5, 9, 6% over the next decade, that's going to be right on the current trajectory. If you take the current unfunded liability, the current projections that we have, that's exactly what we expect to happen. And so as you just saw, Makita's returns or lots of other sets of return expectations are a little low right now. That's okay because our smoothing mechanism, at least for right now, is building some of that in and recognizes that the next decade might be a little lower. If you go longer than that, say, well, what about 20 years? It's actually 6.6%. So we have about 0.4% a year for the next 20 years to work with. And this is just there to anticipate some of the questions of, well, what if the next few years are lower? You can see there's quite a bit of built-in cushion here. The next slide talks about the history of the fund and shows you how the unfunded liability has changed over time, and that even though the unfunded liability didn't go down from 2020 to 2021, that was entirely driven by the change in assumption that Danny had talked about earlier. We went from a 7.25% discount rate to a 7%. That was enough to offset the smooth portion of the investment performance, right? We don't recognize all of it. We only brought in a fifth of it. And so if you could turn to slide 15, that would be great. And but going forward, as long as assumptions don't change and contributions remain in effect, we do now expect the unfunded liability to begin to come down. So we think next year will be the first time, really, in the last 2 decades, that the unfunded liability goes down naturally. You can see in 2011 it went down, but that's because there was pension reforms, there were benefit cuts. This is going to happen because the financing mechanisms and the investments and those types of things work out as planned and begin to reduce that unfunded liability. If you go back to 2016, 2017, when the current funding policy was put in place, our projections at that time expected the unfunded liability to continue to grow for a few more years until about this time frame, and then begin the process of declining. This is going to be a big turning point in the history of SCRS because, one, it starts to give you tangible evidence that you do have a funding period, that you will pay off the unfunded liability. But also, it just makes the communications a lot easier when the unfunded liability is getting smaller, because again, to an unsophisticated audience, it's real easy to just point to that and say, look here, this getting small, the gap between our assets and liability are getting smaller, and we expect it to continue to do so. The next slide gives you that projection of the unfunded liability and the funded ratio going forward. So slide 16, please. And you can see it's actually a pretty quick drop here. We're expecting that unfunded liability to begin to come down pretty quickly in nominal dollars and reach zero, and the funded ratio to really begin to increase year over year going forward. Of course, this assumes 7% return every year going forward. We know it's not going to go exactly like that. However, there's enough cushion, as we talked about earlier, that it's a pretty good probability it's going to look something like this as we go out into the future, say over a 10-year period. The next slide shows you the impact of just this past year. So slide 17 on this same projection. So the gray bars that you're going to see were last year's same projection of the unfunded liability and funded ratio. And then the dark bars are the new projection. You can see how powerful having that big return was in basically shifting the entire timing of a lot of this projection quite a bit. So the gray bars here, you can see as of last year, we thought the unfunded would continue to grow 2 or 3 years and then begin a process of declining. The funded ratio trajectory was much shallower. Now with the strong market performance, assuming that you can then earn 7 from that point forward, you can see we now expect that to begin to come down pretty quickly. So then I want to show a little sensitivity on that. The next slide, slide 18, is based on a stochastic model and is looking at it's asking and then answering some specific questions of probabilities of certain events occurring. Of course, assuming you can just put a distribution around the expected returns. So slide 18, what you see is a few questions. The probability that we're greater than 80% funded in 2030. There's nothing magical about 80% funded or 2030, but they're points of reference to be able to compare the probabilities. And you can see that last year, based on last year's valuation, even with the updated assumptions, we thought there was about a 32% probability of being 80% funded by 2030. That has increased all the way to 52%. Likewise, if we drop down a couple lines, probably the unfunded liability is smaller than it currently is in 5 years out from now. You can see there was only about a 37% probability of that occurring. Now we're looking at something closer to 78%. So that's a very dramatic change. And then really the last one, I think, from an employer perspective is probably the most one of interest, which is, well, what's the probability that our contributions don't need to go up from the 1856? The current statute, the way the funding mechanism works in South Carolina, we're in the middle of a ramp-up period. In a couple of more years, we're going to reach 1856 being received from the employers, and that will remain in place as long as a 20-year payment schedule would not keep to the 1856. But if we ever decide, no, we need more than 1856 to hold to a 20-year schedule, it would have to go up. So the question's saying, all right, what's the likelihood we never breach the 1856? And so you can see on last year's assumption set was about a 60% probability of that being true. Or you could ask the opposite question. It would be a 40% probability that it would be true, right? That we would exceed 1856. And this 1 year's return has pushed that up somewhere closer to 82%, or an 18% probability that it would exceed it at some point in the future. So that's a very dramatic improvement. Now, I will say there's a few caveats here. One, you can see we modeled this with 7% expected geometric return in both cases. So basically it's saying, hey, we had the big return and we get to keep it all, and it didn't change our probabilities of our distributions going forward. And I get that that's a big presumption in itself. And we're going to show you a little sensitivity to that on the next slide. But I wanted to just show you just how much this 1 year really has changed the narrative here in a lot of ways. So let's look at that next slide. Let's look at slide 19. And what we did here is say, well, what if it's true that the next decade should be expected to be lower because of what just happened. And so what we did is we run the whole model, but the first 10 years, we lowered the mean or the expected geometric return to 6%. So slide 19. So we didn't change the assumptions in the val or anything, but we're just saying that the scenarios that we're feeding into it, what if that distribution only expects 6% the next decade and not 7%? What does that do to these probabilities? Hopefully you can see slide 19. The big, and you can see it does pull back, but it's still significantly improved from 2020 valuation. And in fact, it's still a 74% probability that contribution rates will not have to be increased in the future.
Joe, I'm sorry, I think we had a question come up. Somebody had a question.
Question? Sorry?
Yeah, Joe, can you hear me? This is Mike.
I can.
Yeah, the value that you're using, Joe, is that the actuarial smooth value that you're starting from, or is that the market value?
No, these are the market values in these cases.
Okay.
Talking to your group, that's all you're concerned about the most. So yeah, we're focusing on the market value here. And this, all of these numbers are all based on the market value. And that's also why we thought it'd be good to do a scenario where, yeah, maybe today's market value is, if we had that much acceleration, maybe the next few years are dampened on expectation. Well, what if that's true? And you can see here, even in that case, the probabilities are higher, pretty generally higher across the board than they were last year, and substantially so. So again, it's just kind of, and it's also to give a reference that these aren't going to go in a straight line. We know that, and there's a range of outcomes sitting out there. Okay, I'm going to go ahead and do the last slide, and then we can open up for questions. So one more, just the projection for PORS. PORS is the police officer's plan, as you know. It has a little bit more liability to asset ratios. So the things are a little bit different, but in general, they look very similar. So let's look at the next slide. And what we've shown you here is just the projection of the unfunded liability from last year's valuation compared to this year's. Same thing on funded ratio. And what you see on slide 21 is, again, just pretty vast improvement on the timing of those things occurring. And in fact, here we're looking at PORS being fully funded in 2035 if we can do 7% going forward here. So I think we're going to just open it up for questions then, and see if anyone has any questions or comments on the information you've seen here or something else.
I hate to go all the way back to slide 1, and you don't need to revert to that, but under other agencies, we started to see a slight decline in employees, and I'm curious, is that due to existing agencies or municipalities or whatever entities? And this is the green line. Is that for cutting employment, or people retiring and they're not replacing them, or are some of them actually just leaving the system? And is that the beginning of a trend, or is that just a one-time blip and we expect that to continue to level off and stay that way?
That's an excellent question, and it's a trend that we're watching. So I know the SCRS looks at it and watches it. They actually track it by an employer level. I would say that part of it could be related to the start of the pandemic. It is a snapshot, is a certain date. I hear in the news, I'll speak to teachers. You hear, everybody hears about education, tough time to be an educator. And so how much of it is short-term or pandemic related? We're going to see changes there. We certainly saw a decrease in headcount in 2007, 2008 afterwards, but it wasn't for a very different reason too. It was tough budgets, and I don't know if municipalities and counties have the same budget issues that they did a decade ago. Some of the other could be related to the use of let's say not enrolling new employees. And then the other is technology improvement, that You get productivity gains. Are you able to do more with fewer number of employees for the city, provide the same level of service? And I think I've heard this across the country that many of those entities are finding out that they're able to provide the same level of service, with fewer people by utilizing technology, whether it's more web-based, online, and other type, advances. But the short answer is it's a combination of things, and it's something that I know firsthand. We work with people. It's something that's looked at not just in aggregate for all the employer, but for each type, but also at the employer level.
You mentioned not enrolling new employees. What does that mean?
It could be the use of, I should say not enrolling new employees. That's probably not the best term, but I would say maybe an increased use of contract employees or outside contractors. So if you're an outside contractor, then you don't necessarily have to provide them benefits. So that's the better or more accurate term.
Danny, with kind of staying on that topic for a minute, is that a trend? Obviously that's a trend that we're looking at and paying attention, but is there any evidence of that being more of a trend kind of, when you look at your other client states, is that something that you're seeing more of?
We have seen it in others, and I would say it's, and where we watch and pay attention of it in terms of South Carolina is, it seems to be a higher, a slightly higher level of incidence when, for systems that have a relatively higher contribution rate, or it's not just on the pension, maybe they have higher benefit costs elsewhere, where they feel like it comes down to economics that, is it more economically viable for them to maybe utilize a contract employee versus a contract worker than to employ them themselves? So I think it's not entirely driven by the retirement system. It comes down to a number of factors.
Makes sense. Thank you.
And that was actually one of the changes in the experience study that occurred last year, was to lower what's called the payroll growth rate assumption, or the trajectory of the contributions that we're going to receive. And some of that's, inflation related and wage related, but some of it is wanting to lean a little conservative because of the potential this could have. And so we did lower that from 3% going forward to 2.7 on just overall payroll growth.
Yeah, I have a question. If a few slides back, and we don't have to go to it, but it said that there was a 56% probability that SCRS would have a funded percentage of 90% or greater by 2040.
Right.
But a few slides earlier than that, it looked like the unfunded liability would be zero by about 2033 or 34. So I would expect that percentage to be much, much higher. It seems like those two are contradictory.
Well, it does. It seems like it should, but the way the stochastic models work, and then also, you could be overfunded and then get back below funded and things like that. It takes a lot more effort than you think to get away from that something close to 50%, so up to get to 60% or so, and that's why a lot of these numbers, the size of the change is even more dramatic than it looks, because it takes a lot of movement to get these probabilities to change very much. And so it's dramatically, but you're right, it should be close to 50-50 that we get there by 2035. However, it only goes up another 6% a year or so, pushing all the way out to 2040.
I like to think of it this way, that the system actually is exposed to more investment risk on a funded ratio basis when you're better funded. So if you were 50% funded last year, you're up to 60. You had a $6 billion investment gain. If SCRS would have been 100% funded at 2020 going into FY 2021, and you had that experience, you would have actually had twice as much in dollars of an investment gain. You would have had closer to 12 billion instead of 6 billion. And that would have had a much bigger impact on the funded ratio. So what happens is you get some of those higher volatilities, and when you look at it on a funded ratio basis, it can actually move things higher when you're better funded than less well funded.
Thank you guys for this.
Yeah.
Yes, thank you
Very
very
helpful.
much.
Yeah.
Well, it is a pleasure. We look forward to every year to presenting the RSIC, and if there's ever any other follow-up questions, please provide them to Mike. I'm sure Mike will follow up with us, and we're happy to answer those.
Definitely. Thank you, guys.
Thank you.
Thank you for
Thank you.
the information from the actuaries at GRS. Next up on the agenda is our delegated investment report.
Mr. Chairman, this is simply the list of investments that we have closed since the prior meeting, and materials have been provided on all of them, but we do need to reveal this in open session, so I'm just sharing that with you for the record.
All right. Any questions to Mr. Berg on this delegated investment report? All right. As a matter of practicality, I do believe we've got lunch coming in at some point, and I'm going to defer to you, Mr. CEO, as to whether we
want to just go into executive session and lunch, and we can eat lunch and listen at the same time.
Why don't we do that, Mike? Do us the favor of reading the motion to proceed into executive session where we will have lunch and also conduct business there.
Thank you. Mr. Chairman, the motion is to proceed into executive session to discuss investment matters pursuant to SC Code Sections 9-16-80 and 9-16-320, including a comprehensive review of the bonds portfolio performance and a discussion of various underlying holdings and a review of potential investments in the due diligence process, to discuss personnel matters, negotiations incident to proposed contractual agreements, and to receive advice from legal counsel pursuant to SC Code annotated Section 30-4-70. Subsection A1 through 2.
May I have a motion?
So moved.
Second? Second. Any discussion before we vote on proceeding into executive session? Hearing none, all in favor of proceeding into executive session, please say yes.
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 Anyone opposed, please say no. Yeses have it. We are now in executive session. As a result of discussions in executive session, I think we have come out with two proposed motions. Mr. CEO, I'll have you read the first one, please.
Thank you, Mr. Chairman. We have a motion in reference to Asana Fund 3. That would be to adopt the recommendation of the CIO and the Internal Investment Committee as set forth in the summary term chart on page 1 of the due diligence report dated February 15, 2022, as discussed in executive session, authorize an investment of up to $75 million in Asana Fund 3, authorize the CEO or his designee to negotiate and execute any necessary documents to implement the investment as approved by the Commission upon notice from RSIC Legal that all preconditions to closing have been satisfied, and to execute the investment closing certification, and authorize the CEO and or the CIO or their designees to thereafter authorize a custodian of funds to transfer such funds as are necessary to meet the retirement system trust funds obligations with respect to the investment.
May I have a motion to that?
So moved.
So moved. I have a second from Rebecca. Any discussion? Everyone in favor, please say so by saying yes.
Yes.
Yes. Anyone objects, please say no. The yeses have it. All right, we have another motion that, needs to come from, that has to come from executive session. Mr. Hitchcock, would you mind reading that for us, please?
Yes, sir, and this is in relationship to Greystar Fund 11. It would be to adopt the recommendation of the CIO and the Internal Investment Committee as set forth in the summary terms chart on page 1 of the due diligence report dated February 16th, 2022, as discussed in executive session, authorize an investment of up to $150 million in Greystar Fund 11, authorize the CEO or his designee to negotiate and execute any necessary documents to implement the investment as approved by the Commission upon notice from RSIC Legal that all preconditions to closing have been satisfied, and to execute the investment closing certification, and authorize the CEO and/or the CIO or their designees to thereafter authorize the custodian of funds to transfer such funds as are necessary to meet the retirement system trust funds obligations with respect to the investment.
Would someone care to move?
So moved.
So moved, may I have a second?
Second.
I have a motion and a second. Assuming there's no more discussion, all in favor of this, please say yes.
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 Any opposed, please say no. The motion carries. Is there any more business to come before this commission today?
Nothing from us, Mr. Chairman.
Hearing none, I'll call for a motion to adjourn.
I move.
Second.
I have a motion and a second. Any discussion? All in favor of adjourning, please say yes.
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 Anyone that wants, do I have any no's? We stand adjourned. Thank you.